Hello traders, you are welcome back to my YouTube channel. This is Astrofair Trading Limited. So in today's video, we shall be digging deep into one of the most important aspects of trading, which is misconceptions and trading psychology. Misconceptions about trading and trading psychology. This is going to help you either as a beginner trader or an advanced trader. So stick to the end, guys. If this interests you, kindly hit the subscribe button and turn on your notification button so that you'll be the first to always get notifications on any of our new videos. So see you guys in this video. Stay tuned. So welcome back, guys. So the first misconception we are going to be talking about as far as forex trading is concerned is forex trading is easy and requires little effort. A common misconception is that forex trading is an easy path to get rich quick. This is unfortunately purported by many YouTube influencers who flash their fancy lifestyles and sport cars. Perhaps some of these YouTubers are genuinely successful. However, the lifestyle they portray is usually either very extra exaggerated or just a small snapshot of reality. Now, what is the truth? The truth is that forex trading is profitable if enough time is invested into it. As with any other skill, it's interesting to know that forex trading takes time and effort to master. When you become a better, more consistent trader, the time invested may reduce significantly. You need to put that in mind. So you have to put in the effort, the time first, put in the work first. So however, to become profitable trader, you must learn the fundamental of forex trading concept and develop your own forex trading strategy, which requires ongoing practices and refinement. A lot of traders come into trading today and they don't know what to put in the work. They want to do it within the period of 1, 2, 3 weeks, and if it's not working, they back out. Like, think about it, guys. How many years does it take you to become a medical doctor? Or how many years does it take you to become a chartered accountant or a lawyer? Imagine the number of years you spent going to school. In the same vein, forex trading takes time because it is a career. So this is very important, guy. Okay, the second misconception we're going to be talking about is that you need a lot of money to start forex trading. Contrary to popular belief, you do not need a lot of money to start forex trading. And forex is not only for the ultra wealthy. Forex trading is similar to investing in this respect. If you have ever invested before, so it is similar in this respect. So you can begin investing with as little as $10. However, the more money you have to invest, the easier it might be. Now, the truth is that you can start your forex journey with no money. You may be thinking, how can you start forex trading with no money? Although you may not be able to make money without money, that is very sure. You can certainly start learning and practicing using a demo account, which costs you nothing. Very simple. However, when you are ready to start trading with real money, you can usually start with as little as few hundreds of dollars, $50, $100, $200, $500, and so on and so forth. Therefore, don't let the misconception that you need a lot of money to start forex trading stop you from starting your forex journey. This has actually stopped a lot of traders from starting their forex journey out of fear of how much do I need to start trading. You do not really need so much amount of money to start trading. Thank God for prop firms today that you can even buy accounts of $10,000, $5,000, $100,000, and trade them effectively once you sharpen your skill. So this is one of the misconceptions that traders have about forex trading. Next, we're going to be talking about misconception number 3, which has to do with the forex market is rigged. A lot of people believe that the forex market is rigged. Some traders believe that the forex market is rigged and that retail traders have no shot at making money. However, this itself is a limiting belief which prevents traders from succeeding. So if you have this mentality, you need to jump out of this mentality with immediate effect. Although forex market does have large institutional traders such as banks, hedge funds, and government, their primary goal is the same as retail traders: to make money. You are here as a trader to make money, and the institutions are also here to make money. So the truth is that the participation of institutional traders is not proof that the forex market is rigged. It is merely proof that they want to make money just like every other participant. So understanding this can position you to capitalize on their moves, because they control every large sum of money. They bring liquidity and stability to their market. So you can take advantage of their liquidity. You can take advantage of their positions by aligning yourself as a retail trader to the market maker move. Moreover, their trades are often automated using bots and complex algorithms. Therefore, understanding market patterns, price action, and volume helps you trade with the big guys in the market. So you need to understand this as a. Next, we talk about misconception number 4. Forex is a get-rich-quick scheme. No. This should be out of your mind if you are coming into trading. Another common misconception about forex trading is that it is a get-rich-quick scheme. It is possible to get rich trading forex. Is it possible? Sure. Will it be quick and easy? Probably not, unless you are lucky. Get-rich-quick scheme sells you the promise of easy money, an activity where you can make both loads of money with little or no effort. That is not forex. That is not forex trading. So I would like you as a trader to erase your mind from the concept of getting rich quick. As a trader, it's going to take you time. I bet you it's going to take you time. It's going to take you time. So the truth is that forex trading empowers you to build wealth over time. Yes, over time. Although get rich quick scheme promises a quick path to wealth, they are usually the opposite. An easy way to lose money. That is the meaning. A better way to look at the forex market is to aim for small and consistent wins. Don't have the mindset of trying to double your money every trade or every month. Do not have that mindset. It is important. This is important, guys. Very, very important. Like, I'm going to highlight it again and show you that you should not have that mentality. So a better way to look at forex market is to aim for small and consistent wins, and do not have the mindset of trying to double your money every trade or every month. That is detrimental. If you can make 5 to 20% on a monthly basis, you are good to go in trading. So instead, you can set more realistic goals like 5% return every month. Then once you have consistently achieved that, you can stretch your goal to making 10%, 15% per month. This way, you can develop a sustainable and long-term strategy. So you don't need to rush it. You don't need to rush the process. Just take it easy. and that is going to help you a lot as a trader. So you need to have a realistic target. Do not come with the mentality of getting rich quick in trading. This alone has discouraged a lot of traders. It has blown off a lot of accounts because many traders, especially the beginner trader, wants to come into the market within 1 week. They want to double $100 or even times 10 of their account, and that has always led to the jeopardy of their account. So guys, put this in mind and be conscious of this. This is very important. Okay, so next we're going to talk about misconception number 5. Another misconception is that you need to monitor the market 24/7. So you hear people say that, oh, I have to be on the screen 24/7. I don't have that time. So that is another misconception people have. So is it that you cannot trade Forex unless you can commit all your time to trading the market? This turns away many would-be traders with a busy lifestyle who just don't have time to spend hours every day staring at a screen. Of course, if you want to be a full-time trader, it might take you this. You might actually want to spend most of your time looking at the chart, but you can still trade Forex part-time. Like you can have any other things to do and you are still trading. So you do not need to monitor your trade all the time. This truth might be difficult for some people to grasp. However, you don't need to constantly monitor each trade. There are several reasons for this. First, you can use stop loss and take profit orders, which allow you to exit trades when your predetermined criteria are met, such as profit achieved or loss incurred. Very simple. Secondly, you can use automated trading system and bots to conduct trades on your behalf. So with this, you do not need to keep staring at the chart. And also you can use what we call pending order. You can use pending order. That is what we call set and forget. You go to time frames like 1 hour, 4 hours. You put your pending order. When price gets to your desired price, it triggers you in and maybe move in your direction or move against you, depending on your technical skill. So with that, you don't actually need to keep staring at your screen every time. Lastly, you don't have to day trade Forex. That's what we mean. You can do long form of trading, such as swing or position trading. In this case, you will still monitor your trade, but probably won't need to do it several times a day. Now, as you know that we have different kind or different types of trader. We have intraday trader, or you call them day trader. That's number one. Number two, we have swing traders. Swing traders can leave the trade for complete 1 week running, 2 weeks running. Intraday trader, they enter a trade within a day and they close the trade within a day. Then position trader are long-term traders. Those are the big boys in the market. Talk of hedge funds. Those guys are position traders. They can open a position in January and close it October, November. That's a very long time. So this one, they will just monitor their chart, their trade once in some weeks. They'll just leave the trade running, and mind you, they have enough capital to actually do this. So you can be a swing trader or a position trader if you do not have the whole time in the world to keep staring at your screen, looking at your chart all the time. So you can go be a swing trader or a position trader. I think that is very clear, guys. Okay, so we are going to be looking into misconception number 6. Forex is only for professional traders. A lot of people are confused themselves with this notion that Forex is actually for professional traders. You can as well be a professional trader. Every professional trader was once a novice in one way or the other. Some people don't even venture into trading Forex believing it's just for professional traders and is too complicated or risky for the average person. The fact is that no one is born with this skill. Every professional trader became a professional trader by engaging in the activity, by trading, by learning, by putting in the effort. So if you think Forex is what you want to do, thinking about the freedom and every other thing that you have to benefit trading the global financial market, I think the time to invest into it, it's actually worth it. The time you invest into it, it will be worth it at the end of the day. So don't be carried away with the misconception that Forex is only for professional traders. Mind you, every professional trader was once like you. So this mental block keeps them on the sidelines. And even if they do start trading Forex, they begin with a victim mentality and usually don't get far. So this can keep you to be a victim mentality. It can make you a victim mentality. I'm talking about this particular notion, this particular mindset. Forex is only for professional traders. Do not put that in your mind. Professional traders were once novice. Now the truth is that Forex trading is not an exclusive for us only. You know what I mean? It's for kind of for some set of people only. Anyone willing to put in the time and effort can learn Forex trading. Yeah, anyone that is willing to put in the time, the effort, can actually learn Forex trading. However, many retail traders either start trading Forex with unrealistic expectation or are unwilling to put in the work. Either way is a recipe for failure. Yes, it's a recipe for failure. If you are not willing to put in the work and you have unrealistic expectation, for example, you want to use $100 to make $1 million, is actually unrealistic. It's unrealistic. So you need to have a realistic expectation. If you are coming into trading, have a realistic expectation and be ready to put in the work. But for those who are willing to invest their time and effort, Forex trading can be a lucrative side hustle or a full-time endeavor. Yeah, you can make it a full-time endeavor because it's a business. And you must treat it as a business so that it will pay you as a business. This is very important, guys. So please put those things in mind. So next, we are going to be talking about Forex trading psychology. Stay tuned, guys. Okay, welcome back, guys. So in trading, it is important that you actually have understanding of what psychology is. Psychology is very important to all traders. Every trader that is going to be successful in trading must have the right psychology. So when we say psychology, what are we talking about? We are talking about the mindset of trader. See, what you do when you put on a trade is what makes you a trader, not just putting on a trade. What are you thinking when you put on a trade? Are you afraid of during your trade moving against you? All of these are psychology that needs to be put in place. Some traders get into trading so early, even before the market comes into their right position to start buying or selling. Most of them don't have the patience to actually wait for price to come to the desired level before they start putting on a trade. So most of the psychology we are going to be talking about today is fear of missing out. We call it FOMO in Forex. Fear of missing out. You see a trade moving largely in a specific direction and you feel you're already missing out of the market, and you jump into the market unknowingly to you. The market is going to reverse, and with that, you are already having some drawdown on your account. So FOMO is one of a trading psychology that has destroyed a lot of traders' accounts and also their emotions. So FOMO is a well-known psychological phenomenon that affects traders of all experience level. Either you are an advanced trader or you're a beginner trader. Some of these traders still have fear of missing out. It refers to the fear of missing out on a potential lucrative trade or a market move. Some of us try to always catch the falling knife. You see an aggressive candle moving in your direction, and because of that volatility, you want to start running to join the trend. You see market moving with speed to the downside. Instead of you to wait to see what the market is going to do, you quickly jump into the trade, and unknowingly to you, the market is just pulling your leg and they are going to reverse against you. That is what FOMO, fear of missing out, can do in the life of a trader. It can make you to enter the market when the market is not ripe, just because you see aggressive moves coming into the market. Most of the times, those aggressive moves are actually traps for you to actually get into the market. So it is important that you wait for market to come to your desired price level before you start engaging in a buy or sell. So when traders succumb to FOMO, that is fear of missing out, there is a problem. Once you give in to FOMO, there is a problem. They may impulsively enter trades without conducting proper analysis. That's first thing, leading to poor decision making and unfavorable outcome. Have you ever noticed that the market you don't analyze and you take is actually going to affect you in a way? The market that you just see within a short period of time can actually affect you in a way. It can affect you in a way. So because you do not really analyze that market, you just saw that, oh, this market looks beautiful, let me try to engage with it, and without knowing to you, it is going to pull back against you. Okay guys, this is very important. Following the herd is another trading psychology. Fear and greed often fuel a tendency to follow the crowd, especially in times of market volatility. When there are news events, traders tend to follow the crowd. What does this mean? Traders may be inclined to enter or exit position based on the action of other traders rather than their own thorough research or analysis. So they act on what their friends are telling them about a particular market instead of their own thorough research or thorough analysis about the market. So you do not want to be doing this, guys. If you're going to be a successful trader, this should be out of the way. So do not follow the crowd. Forget about the social media influencers you are looking at. Forget about their trade setup. Just make sure you build your own personal strategies that has been working for you over the years. So this herd mentality can result in entering position at wrong time or exiting prematurely, as emotions drive decisions rather than rational judgment. So you don't have to be emotional. So rational judgment is very important. So you have to be at least rational, be inquisitive about your own trade setup, not be emotional about the trade and following what other traders are actually saying. If you look into it vividly, most of the times you listen to other traders, you tend to actually fail those trades, and those trades might eventually go in your own predicted direction. So it has happened a lot of times. So you need to have this balance as a trader. Do not follow the herd. Do not follow a lot of people or your friends to take trade or opt out of a trade prematurely. This is very important. Then the next psychology is impulsive trading. Emotional impulses can lead to irrational and unplanned trades driven by the desire for immediate result. You are so tensed to have result immediately, and with this you do not do proper analysis. You do not do proper work you need to do as a trader. So this can lead to overtrading, which in turn leads to increased transaction cost and reduce overall profitability. Overtrading can also result in emotional exhaustion, leading to poor judgment and participating further mistakes. So it can precipitate further mistakes. Please be very careful about impulsive trading. So you need to be calm. Go and check the lifestyle of successful trader. There is this calm nature they have. So you need to be calm. Look into your trade well. Do not overtrade. Now, predetermine how much you are willing to risk on that particular trade. Do not open multiple positions at once, because you are actually increasing the cost of transaction, and that one alone can reduce overall profitability. So it is important for you to know this, guys. So do not impulsive trade. Don't do impulsive trading. This is very important. So another trading psychology is ignoring stop loss. This is very important, guys. Guys, if you want to be a successful trader, you should not neglect this. Ignoring stop losses. Stop losses is your protective measure when you are trading. Do not forget that the goal of trading is to make money, protect money, and make money. So the aspect of protecting money, protecting your capital, cannot be overemphasized, because if your capital is gone, you're going to be the one that will look for money at the end of the day. So it is imperative for you to embrace stop losses, definite stop losses, and do not do mental stop losses. What do I mean by mental stop loss? You were watching the market. I don't know if it has happened to a lot of you before. You are watching the market, like you have the mindset that when the market gets to this particular level, I am going to opt out in loss. That is mental stop loss. It is for mentally retarded people. It is not good for you as a trader. So you must first predetermine your loss. Do not forget, to be a successful trader, one of the criteria is that you must predetermine how much you are willing to give to the market, how much you wish the market to take from you first, before you determine how much you are willing to make. So that has to do with percentages of your account. How many percent of your account are you risking? Some risk 0.5% of the account, 0.7% of your account, 1% of your account. Whichever percentage of the account you want to risk first, you must predetermine that, and that will actually go with your stop loss as well, because you cannot determine how much you are willing to lose or to give to the market without considering stop losses. So your stop loss is a protective measure. So the fear of realizing a loss can cause traders to ignore predetermined stop price or exit point, price levels where they would plan to exit a position. Very important. So if the trade is going against me and it has moved against me in 12 pips, 10 pips, I am out of the market, and you must place it there on your trading platform, because if you expose your account to the market without using stop loss, what you are trying to say is that you have the whole money and the market should take as much as it wants from your account. And once that happens, you are putting your account in jeopardy. You are jeopardizing that account already, because If you have the first loss and your first loss is more than 20% of your account, there is a problem. Before you make that 20% back again, it's going to take you a lot of time. You will now be forced to do what you were supposed to do from the onset. You will now start building from now, making little money until you balance your account, your equity comes back before you now even think of making profit at all. So you need to put this man forward. Stop loss, you need to put it ahead of everything you are doing. It must be ahead of everything you are doing. In fact, it is not as your take profit is not as important as this man, as you can manually exit your trade at any time. If you are in profit, if you are satisfied with your profit, you can manually exit the trade, close your trade in profit. But do you know the problem that traders have is they trade in hope. Even when the market is going against them, the price is going against them massively, they still wait open that the market is possibly going to come back in their direction, and that is detrimental to their account. So you do not want to start doing that as a trader. Either you're an experienced trader or you are a beginner trader. This is very important. So top angle, exposing your capital to the market, because when you do that, you are incurring more losses. Market can go against you for complete 1 month if you are not careful. So that is detrimental to your account. So please guys, learn how to use stop loss. Learn how to use stop loss. So if you enter a position with a stop, the bleeding level in mind, set a stop loss order, and if it gets triggered, accept it and move on. Yes, if you set your stop loss, you are in a downtrend. For example, market is coming down, you enter the trade at this position for a sell, at this level for a sell. Then market eventually hit your stop loss right here. Let it go. You're going to see another opportunity. Another opportunity is going to come. So wait for the next opportunity. The next opportunity can give you times 3 of what you've just lost. So you cannot ignore stop losses when it comes to trading. So you must have a proper trading strategy, a very good trading strategy that will enable you to put your stop loss in a very distinct place on the chart. So that is on that, guys. So this is very important. So another one we are going to talk about is chasing losses. You do not want to start chasing losses. It does not make sense. This is driven by the hope of regaining lost capital. Traders sometimes double down on risky position or hold on to losing trades for longer than necessary. Do not hold on losing trade longer than necessary. So chasing losses increases the potential for large losses and often cause traders to ignore risk management. Mind you, in trading, there is something that is super important, that is your risk management. But when you chase losses, you lost $100 right now. Because you lost $100, you are so curious and you are panicking, and the next trade you want to make $500. Now you are just chasing this loss, this $100 loss, and eventually you might still lose more. So when you have 1 to 2 losses in a day, just stop trading and come back the next day, reanalyze the market and come back fully. So you might possibly get your money back the next day. So if you have a series of losses, first day, second day, just keep calm, come back, reanalyze the market, look for what the mistakes are, and come again. It might not be that day, you can come again another day. So just relax. Instead of chasing all those losses, it will not help you as a trader. It's just detrimental, too detrimental to your account. Another one we're going to be talking about is jumping the gun on profit taking. On the other hand of the spectrum, some traders may pull the trigger too early on profitable trades that are supposed to give you massive profit, because you now have $100, $200. You start cutting those profits, exiting prematurely out of fear or impatience. So the fear of giving back profit can hinder potential gains and create a cycle of missed opportunities. One thing that sets successful traders apart from those who are struggling is the ability to cut losses early and let the winning trade run. So this is very important. You have to let your winning trades run. Now, some of us are always afraid of giving back whatever we have made to the market. Here is a strategy you can use. If a market is going in your direction with 40 pips, you can lock the profit, or you can take half of the profit. That is one of the strategy. You can go reduce your stop losses. Just if you use 0.5 or let me say you use 1.0 standard lot on a particular trade, and the market is already moving 40 pips or 50 pips in your direction, but it is yet to get to your target, you can go back and remodify your stop losses. Your position. Go back, remodify your position. That is, reduce that 1.0 to 0.5, and it will close some of the profit for you. It will close half of the profit for you. Then you can as well move your stop losses to your entry to break even in case anything is going to happen. So these are the things you do when you are trading. Trade management is also very important. How do you manage your trade is very important. Some of us traders, your trade is already giving you 100 pips profit. Instead of you to come lock your profit or secure some profit, you leave it open. Then the market comes back against you, get back to your entry, even give you some losses. That is prohibited in trading. That is not a right attitude for traders. So traders, this is very important. So guys, here comes the end of our trading psychology for today. So if this is what you are interested in, guys, don't forget to subscribe to this YouTube channel, and we will keep updating content that are useful to you as a trader. So stay tuned, guys.